So we have a lot to cover here in this video, a bunch of news as well as some commentary around Nvidia. In this video, we will take a look at how investors are positioned in the options market, in just overall positioning in Nvidia heading into earnings tomorrow. There's about a 3-minute long clip on CNBC that goes over just this. And for the quote, most important stock in the markets, that's important. I put that in air quotes because this is the top article on CNBC. It says Nvidia has become the world's most important stock, adding pressure to upcoming earnings report. For the key points, it says Nvidia's stock has turned increasingly volatile as investors look for any sign that large cloud providers are showing a changing appetite for artificial intelligence processors. The chipmaker has been the primary beneficiary of the AI boom and is poised to report a fourth straight quarter of triple-digit revenue growth. Wall Street will be particularly focused on the forecast as year-over-year comparisons get more difficult. And on that note, Nvidia is a big leader today, even in regards to other big tech names. Apple is your only other big tech stock that is positive, a part of your Magnificent 7 or Super 6, if you will. Apple is up 0.42%. Nvidia is up 1.5%. Then you have Meta that's slightly negative, Google that's slightly negative, Microsoft up down 0.4%, and Amazon that's down about 1.5%. You also have Tesla, if you want to group Tesla in that category, down 1.6% today. So one thing is clear, markets are getting ready for Nvidia earnings, and Nvidia earnings are going to be the next big catalyst for markets. But really only for big tech. Nvidia earnings, let's say Nvidia doesn't impress us and the stock sells off, that's going to affect big tech a lot, but it may actually pave the way for small caps and value and mid caps to actually outperform. Fundstrat on X writes, small caps have begun to bounce back sharply. On a relative basis, there does look to be some work that needs to be done after the recent damage. However, this past week has certainly helped to, quote, lay the groundwork in many respects, given its strong rebound. And it's also worth noting that Nvidia has rallied like 50% in the last couple of weeks heading into this earnings report. Well, I stand corrected. You've rallied about 42% heading into this report, so I wouldn't be surprised if you did get a little bit of selling after the report, even on a really good report. And that's my personal opinion. But as far as what Nvidia is actually going to report, I don't think there's anything that would suggest Nvidia is going to have bad numbers or a bad guide to give us. So since we are talking about Nvidia, let's go ahead and play this clip from CNBC about just that. This clip says Nvidia earnings. Here's how options traders are positioned.
Now is Susquehanna's co-head of derivative strategy, Chris Murphy. Chris, how would you say this positioning compares to prior quarters for Nvidia?
Well, it's one of the most actively traded earnings you're ever going to see. So there's a little bit of everything. If we were to pull out one trend, it would be selling puts on the downside. The downside's a little bit offered. So what that's telling you, as you can obviously look at the chart on the screen, some people have missed the Nvidia rally. They are willing to buy on a dip. And one way to represent that is to sell puts on the downside. So like I said, you see a little bit of everything in something that trades as much as Nvidia, but that would be one trend that I could pull out leading into this earnings.
How do investors typically utilize options here? Is this something where they hold exposure to the shares themselves and then use options to hedge? Or is it fair to kind of read this as a directional bet per se, or is it more of a kind of piece of an overall portfolio construction looking at Nvidia?
Piece of the overall construction, I would say that it's a great situation for options liquidity when you have something that trades as actively as Nvidia. You have call buyers on the upside looking for continued momentum. You have those who are long looking to take advantage of that 9% move by overwriting. They're offsetting to a degree. You do have some hedging, a little bit overwhelmed on the downside, a little bit overwhelmed by those who are selling downside puts that are willing to buy dip. So, because Nvidia is so actively traded, you can use the options market not just to pull out that 9% implied move, but you can also pull out the probability of, let's say an up 20% move versus a down 20% move. And kind of what you mentioned is the options market is pricing in higher chance of an up 20% move than a down 20% move, mostly in response to the trading flow that I mentioned.
The stock is up, Chris, 40% since the August the 5th low. Obviously, that's a striking move for most normal stocks. Is it that striking for Nvidia? And when it's come off the back of such a quick surge, does it change how you look at things and change the action that we're seeing?
Yeah, when we're able to have an opportunity where we think we can recommend, volatility at a fair level in a name like Nvidia that moves around a ton. Once again, you can point to, yeah, sure, it's a 9% implied move, but if you look back at the last couple of earnings, you have a up 24% move a little more than a year ago. So, if we see sharp moves like these, and the general trend since the August low was selling volatility in aggregate across everything. So, when we think volatility is coming back more towards a fair level, we're biased to recommend going long, especially when you get, a 24% move one out of every couple earnings.
That's a good point. And with Nvidia, 6% of the S&P 500, even if you miss the rally or you don't have exposure to Nvidia, this impacts the market in a very big way. Thank you, Chris. Appreciate your perspective.
Okay, so that's fascinating. We're pricing in a 9% implied move up or down, but you're also pricing in a 50% chance for Nvidia to stay within up or down 10%. So in other words, there's a 50% chance that Nvidia could move over 10% to the upside or more than 10% to the downside. That's a lot. That's a pretty high chance. Options markets are also pricing in an 8% chance of a negative 19% down move and an 11% chance of an up 19% up move. So what this is really telling you is people are more skewed towards a larger outsized up move than a larger outsized down move. What I will tell you is this is a lot closer to being kind of even, right? 8% chance of a 19% down move, 11% chance of a 19% up move. That's a lot higher chance of a down move than what you've seen in prior quarters. In prior quarters for Nvidia, it was usually around a 5% chance of a 20% down move and around a 15% chance of a 20% up move. So you're actually getting a closer balance for this earnings. Now, again, if Nvidia washes on earnings and falls 20%, yeah, markets are going to be up shit's creek pretty fast. But from my standpoint, we really don't have anything to suggest that we're going to get bad enough news to justify some kind of large drop. But it is not uncommon to see Nvidia sell off 5% after earnings, 10% over the next, 2 weeks or so following earnings. And I don't think that would need to be a big negative catalyst for the markets. I actually think as far as a broadening out for our markets, that would probably be a good thing if Nvidia did take a little bit of the back burner. It would probably force some investors to buy other things besides just AI stocks like small caps, mid caps, and value. So obviously Nvidia, every time they report earnings, is important for markets, but I don't think it has to be the end all be all if it's bad. Even if it's good for that matter, I really don't think over the next couple of weeks Nvidia is going to be the main story. I still think the main thing we need to be watching for is economic data. If it's strong, that's good. If it's bad, that is not good. Because historically, when the Fed goes to cut rates for the first time, if the economy is weakening and the Fed is cutting into weakness, on average, the S&P falls about 23% upon the first Fed cut. If the economy is doing okay, which very rarely happens, then you get soft landing like scenarios. You get a 1995 where markets were actually up 20%, almost 20%, the first 4 months after the first Fed cut. So it's all about the narrative of this economy heading into September 18th, which is the meeting in which the Fed is going to cut rates for the first time. And we did get some economic data today that is kind of encouraging, kind of not encouraging, some good, some bad, kind of mixed across the board today. We'll take a look at that in just a second, but listen to this clip first. This clip is titled, "Fed Rate Cuts May Not Help the Economy Avoid Recession," says Northwestern Mutual's Schultz. And I mean, there's something you gotta respect about, someone coming out and being, bearish or not as bullish, trying to, see through some of the good and bad, right? To try to give it to you raw and actually come out and say that we could have a recession. Like, big money is not talking about that. So you almost have to respect someone's opinion about a recession in this environment. Now, if everyone was crying wolf about a recession, then, you got to respect the bulls a little more. Right now, everyone's calling for a soft landing. So I think you got to respect the bears a little more. And I think no matter if you're bullish or bearish, you can gain some perspective from this clip. And that's really the reason I'm playing it.
The major indices continuing to hover around those all-time highs. Can the momentum last? That's up in the air, of course, for everyone, including our next guest, who does expect a recession on the horizon. Joining us, Northwestern Mutual Wealth Management CIO Brent Schutte. Brent, great to see you. Thanks so much for joining us. So just break that down, what I just alluded to. You do think a recession's coming?
I still think it's greater than a 50% probability. Look, I think we all think because the Fed is cutting rates that it's the magic elixir and it's going to allow us to avoid a recession. If you look at the last 4 recessions, and you can include COVID in this, and I don't know if I should or not, but the last 4, the Fed has actually cut before the recession ensued, and we still had one. I think the question this time is whether or not they've already waited too long. Mike mentioned in his commentary the labor differential falling. That is a sign the labor market is weakening. And typically, when the labor market weakens, it tends to trend. And that's where I think the question is going to be answered over the next few months. Is it a soft landing? Did the Fed actually cut on time, or did they wait too long? And I think it's probably more likely the latter. And that's why I still think there's a greater than 50% chance probability that we fall into something that we eventually call a recession.
So how are you positioned then within, let's say, U.S. equities? Are you significantly underweight at the moment?
We are slightly underweight, so it's not that we think there's going to be a massive recession. It's one that we think will be mild, and I think there's just a lot of optimism right now. So Mike mentioned sentiment. I think it's quite the opposite. You mentioned all the billions of dollars in those triple levered funds. Look at the AAII sentiment survey, which is an individual sentiment indicator. It's been above 50. At least it was above 50 last week, which points to lower returns in the future. And I would note, even in the conference board today, they asked a question on stock prices. In the next 12 months, it's at levels just off the recent highs and at levels above where we have been historically, except for, I believe, the beginning of 2018. And so it's pretty elevated. Against that backdrop, we are just a bit concerned. The good news is that there are opportunities in markets away from those things that are triple levered, things that have already priced in some sort of recession, like small and mid caps, where I think there's optionality here for longer term investors to think about how cheap those are because they haven't participated as much because people have been already worried about a recession. And so I guess it's a bit offensive, defensive, or a bit more offensive on the equity side, maybe a bit more defensive, just in shrinking that down a bit given where we're at currently.
Are you altering your portfolio at all in advance of the presidential election?
No, to me, what's more important is where we're at in the business cycle. So I think there's going to be volatility around that. Certainly we'll see that. From a bigger term perspective, I think presidents certainly can have an impact, but the economic cycle is pretty powerful, and that's where we're focused more on where we're at in that business cycle, which is late. I think afterwards we'll certainly pay more heed to it from the standpoint of individuals and sectors and what policy actually comes from those individuals. I think the one thing right now is that neither one seems to want to deal with the deficit, which I think is a longer term issue, despite our positive bent on bonds right now.
How important is where the 10-year is for your view on U.S. equities? And more broadly, how are you advising your clients to be positioned in the long end of the yield curve, short or long maturity?
So we have extended our maturity. We actually extended it out earlier this year on the belief that a recession was nearing. I think we did that in June. So we are a longer duration. Certainly, I think from an asset class perspective, you have to look at what alternatives offer. I don't think the S&P 500 should trade at I believe, the third highest CAPE ratio in history when the 10-year Treasury yield around 4%. I don't think that's a kind of a match that usually goes together. And so I think if bond yields were to move lower, certainly then valuation is a little bit easier on the equity side. But right now, with a 4% 10-year and a 22 times earnings on the S&P 500, I think that's a bit extended on a relative basis, and that's where we tilt more towards small and mid cap, which I think have a bit more of a valuation cushion embedded in them.
I would love to buy that guy a beer. We have like the same strangely the same kind of outlook for markets and for the economy. Like, I think that was honestly the most level-headed, non-emotional take on our markets that you have probably heard on this channel in a long time. He said he believes the odds of a recession are greater than 50%. I personally think they're around 60 to 65%. We agree there. We also agree that small and mid-cap stocks provide a much better value proposition than big tech, than a lot of the stocks that have done very well. Because as I've said here on this channel, even if we do go into a recession, a stock like Nike, for an example, it's a larger cap name, but it's already priced for a recession. CVS Health, already priced for a recession. Dollar General, already priced for a recession. And there's many other stocks that fall in that category. Just look around. There's deals on a lot of stocks. And if we don't fall into a recession, we avoid a recession, then there's a lot more upside to those names than what could be out there for big tech. So it's just balancing the risk to reward in different areas of our markets. There's not a great risk to reward in big tech. There's a great risk to reward in small caps and mid caps. And that's why I've been so behind Tom Lee's call for a small cap rally, because if we do avoid a recession, small caps are going to do very well. If we go into a recession, most of the downside is already priced in anyways. So perhaps there could be less downside in small caps from these levels. So it's kind of like what he said. Again, offense, defense. You can be offensive in some areas, but I think you still want to have a lot of cash on the sidelines. I think you still want to be ready to take advantage of any buying opportunity that we do get. Now, he did reference this survey. This is the AI Investor Sentiment Survey. This is something we look at quite often here on the channel. And you did just see a big jump from August 14th to August 21st, from 42.5% of investors that were bullish August 14th to 51.6% of investors that are bullish. You went from 28.6% of investors that are neutral down to 24.7%. Bearish investors dropped from 28.9% to 23.7%. From August 7th, bearish investors went from 37.5% to 23.7% in the latest survey. That is a 14-point drop in just like 2 weeks. Now, historically, this survey has been around a long time, and it asks one simple question, and that's what's represented here. What direction do AI members feel the stock market will be in the next 6 months? Now, anytime you're over 50, that generally means lower returns to come. And you're actually close to the 1-year high, which the 1-year high for bulls is 52.9%. You're currently at 51.6%. So if you think about the AI euphoria, if you think about some of the broader based rallies we have seen in the last year from November through October through December of 2023, even some very broad-based rallies, some very, bullish moments in the last year. We're almost as bullish now as we were during any point of that, which again just points to an unfavorable risk to reward, especially heading into September. And as you can see here, over the past 10 years, the month of September tends to be negative 2.6%. Now, over the last 4 years, the best September we have had was 2020, and you were negative 4.1%. That's the best out of the last 4 years. In 2021, you were negative 5.0%. In 2022, you were down 9.6%. And in 2023, you were down 5.1%. So, I mean, we're looking at like an average 6% or so decline in September for the S&P. in the last 4 years. We are heading into September, which is going to be next week, and that could bring with it a seasonal correction. And I do think it depends on the economic data as well. A correction is one thing. It's a correction. It comes, it goes, it's over with, right? But if you do get that seasonality coupled with bad economic data, and then you have a larger fall. Although that's not really my base case assumption at this point, I do think economic data is so lagged behind that what we're seeing right now in the economy will not be reflected in data for probably 3 months from now. I think from that perspective, we're probably okay in the near term as far as economic data. Where I would be more worried is towards November, December of this year. That's where the data could start to turn sharply worse. And again, I will share this chart from Lance Roberts again that just kind of shows what I'm talking about. If any logical person out there could say, what are the odds of a recession? They're not zero, okay? You might say 20% if you're in the soft landing bull camp, which that's stupidly low. I hope none of you guys believe we only have a 20% chance of a recession, because that's obviously crazy. Okay, just looking at the economic data that we have seen, there is no reason to suspect the economy is going to hold up under the kind of pressure that we have. It's really just speculation to say. It's really just a on the whim opinion to say everything's going to be fine. There's nothing that supports that. There's nothing historically that supports that, and nothing in, again, the data that supports that recently. Yes, there has been some good data, but there's been a lot of bad data as well. The S&P 500 is pricing in a 0% chance of a recession. I don't care if you are the most bullish investor out there. You're going to say there's a higher than 0% chance of a recession. And that's part of the problem as you price in more of a chance of a recession, even if this goes to 10% or it goes to 20%, 30%, 40%, 50%, hell, a coin toss. That will mean a lot of downside for markets. Even just to put it into a little bit of reference, on August 5th, the low that we just had recently, markets still had a 0% chance of a recession. Zero. Zilp. Nothing. 10% correction. 0% chance of a recession. So where do you think markets could go if we do head up to a 50% chance of a recession? Now, before we get into the data that came out today, former Fed Mester says, I don't think the Fed is behind the curve, and I don't support a 50 basis point rate cut out of the box. Home prices hit a record high in June on the S&P Case-Shiller Index. Year-over-year home prices were expected to come in at 6%. They came in at 6.5%, and month-over-month home prices were expecting a 1% rise. They only came in at 0.6%. So that's actually good. ECB consumer confidence came in at the highest level you have seen in the last 6 months. At 103.3, we were expecting a number of 100.5, and last month was revised upwards from 100.3 to 101.9. So consumers feeling a little bit more confident. The USCB consumer confidence report shows the average 12-month inflation expectation dropped to 4.9% in August, the lowest since March of 2020, and consistent with slower overall inflation and declines in some good prices. But the CB Consumer Confidence Report also shows consumers' assessments of the current labor situation, while still positive, continued to weaken, and assessments of the labor market going forward were more pessimistic. This likely reflects the recent increase in unemployment. I think this more so reflects a lot of businesses slowing down, and as the business slows down, then layoffs become more of a topic of conversation. Take, for an example, the restaurant that I have worked at since 2017. We have now started to reduce hours for everyone. And this was something that was just unthinkable a couple of months ago. And it's just because businesses slow down. People are not going out to eat as much. People are not spending as much money when they do go out to eat. This is likely a trend, not just in restaurants, but in other areas as well, that I think is probably going to get worse from here. And soon the restaurant I work at will be doing layoffs, and, well, other restaurants have already been laying people off for the last couple of months. Here today, the percent of stocks trading above the 50-day moving average is down 3.5%. So 3.5% of all stocks are falling below their 50-day moving average today. The overall total is 63.8% of stocks trading above their 50-day moving average. You've rebounded a lot. You're back to basically where you were before that flash crash, yen, carry trade, implosion event. I think there's room for a broader market rally here. I think there's also a lot of room for things to get worse from here. And I think that's why the economic data will be so important. And that's what will really drive markets higher or lower. Now, if you're looking at the headline S&P, though, it's all about Nvidia. If Nvidia, just to do some math here, is 6% of the S&P and Nvidia goes up 20%, that's automatically going to cause a 1% move in the S&P 500, a little bit over a 1% move, a 1.2% move or so in the S&P 500. So that's going to be huge, okay? Assuming Nvidia could move 20%. If Nvidia moves 10%, that's a half of 1% move for the S&P. Just like that, just off of Nvidia, let alone a Microsoft sympathy move, an Amazon, a Google, a Tesla, a Netflix, a Facebook, all those other companies that also have large weightings in the S&P. So theoretically, if Nvidia does rally 10% on earnings, just with the sympathy reactions, you're probably going to get a 2% day for the NASDAQ. Maybe more than that. Maybe a 3% day for the NASDAQ and a 2+% day for the S&P. Just really based on big tech. Now, if markets broaden and go higher on that, like small caps, the equal weight S&P, which is underperforming today. The equal weight S&P is down 0.03%. The headline S&P is up almost 0.2%. If we did see a broadening out at the same time, big tech really accelerated, that would cause a crazy move for markets. Okay. Now, vice versa, if Nvidia falls 10%, it's going to have a very negative impact on markets as well. So in the very near term, it's all about Nvidia. I have reasons to believe Nvidia is priced for good earnings. I think we're going to get good earnings. I think we're going to get good guidance. There's nothing in TSMC's, AMD's reports, or Qualcomm, or any other chip maker, Broadcom for that matter, Marvell, like all of them have come out with decent earnings, good or okay earnings. Most of them have been really good earnings still. Nothing to suggest Nvidia is going to be any different, but I do think Nvidia is kind of priced for really good, and it is possible we could see a 3 to 5% pullback following Nvidia earnings, and that wouldn't surprise me. I also wouldn't think that would be the end of the world for markets either. As long as it's not a miss on guidance, I think we're going to be just fine. And I think Nvidia is going to be just another one of those catalysts that is really hyped up that comes and goes, in my personal opinion. And I do really think it's a toss-up between Nvidia going higher or not. I do think 5% is probably what we're going to get, up or down. I'm not really expecting an outsized up move. I'm really not expecting an outsized down move either. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.